Now the tools you're seeing here are part of the Jigsaw Trading toolset. And what we can see here, we can see market depth, bids and offers in two places. First of all, on the depth and sales, we've got this inner blue column, inner red background column, and that's showing us the bids and offers. And that information is current right here, right now. Then we can see the auction vista chart, and we have offers above and bids below. And the lighter colors indicate more depth in that area. So everything to the left of this vertical line is historical, and to the right is here and now. We can also see order executions on the depth and sales over here with the current trades columns, and this is showing sellers that sold to bidders in red numbers here, right in the middle, and buyers that bought from offers in the blue numbers here. And this is just showing activity this time round. It's not cumulative, and it will be reset when you come back to a price. Now on the auction vista, we can see order executions in two ways. So between the yellow lines, we have what we call a trade thermometer. And you can see over here on the left, we have this long run of red. And that means that during this time, the aggressor executions, the market orders submitted, were mostly sell orders. But that overall, the volume really wasn't significant. Then you have the large trade circles. They show when exceptional volume trading occurs, but not at any specific time splice or specific interval, but over time at a price. And the size of the circle represents the volume of trade, and the colouring represents the balance of trade. So more blue represents more buy market orders, and more red represents more sell market orders. And we can see these circles develop in real time and move to the left as they build. As soon as that exceptional size is detected, the circle will start building, and as long as we're trading there, it'll just get bigger and bigger and show us the balance of trade. Now many traders will be more attracted to the charts and feel put off because of the numbers on the depth and sales. Well, the depth and sales is all about current information, but surprisingly, it's not really all about the numbers. It's about the pace of the market, the way it speeds up and down, prices that are sticky and prices we can't hold for a second. And of course, it's also about how much volume it takes to get through prices, but mostly it's about movement. And we still recommend people new to order flow start off with drills on the depth and sales here so they get like a raw, unfiltered, organic feel for the order flow. And people benefit from seeing common order flow events playing out here first, so that when they come over and look at the chart, they've got a really good understanding what this visual representation is really telling them. Now I still use the depth and sales for right here, right now, refine and entry analysis, but this history has given me a valuable overview. I'm going to walk you through a few slides now so you can get a feel for what the history brings to the table and how you could incorporate it. Now first of all, we know that some market depth is real and some is fake. Sometimes the market depth reacts to price approaching it, sometimes price reacts to the market depth. So in this case, the market depth was real. So we'd actually been up to 30.61 on this day, down to 30.46, and this is retracement back up to 30.57. Now at this point, as the market's retracing back up, you're probably either looking for a fake breakout, head fake, double top, or to get short on a failed retracement. So for me, I'm thinking this market's already done its reversal. Now I'm looking for an entry. Now on the way up here, we can see exceptional depth above us, and at each price, we actually traded that depth, and the offers actually stayed firm as we traded through them. And we can tell that because it took exceptional volume to trade through exceptional depth because we got the circles. Now trading wasn't balanced on the way up. If we look at the aggressor side, the market orders, they were predominantly buyers, and that is normal on the way up. In any move up, normally expecting an imbalance of around 1.5 to 2 times buyers to sellers with price progression, okay? When you don't get the price progression, that's a heads up. So buyers were in the majority on the market order side. Sellers were quite happy to progressively absorb more and more of that buying as we moved up. Now, as we got to the top, the imbalance was actually much larger than 2 to 1 as we reached this turning point. And there's a noted lack of aggressive sellers. And there's a reason for that. There's no need for smart sellers to be selling at the market if they're going to be absorbing this buying. Okay, so the smart sellers are just saying, okay, we'll sell you some contracts, we'll sell you some contracts. They don't need to put sell orders, market orders in at this point. Now, as the market rolled over, we can see that moderately high offers followed the market down. And this is very typical of market maker activity, looking to pick off traders that take trades against the trend. So where do you actually enter a trade here? Well, first of all, you always have to have context. And in this case, we're in a pullback, in a move down. So that's good context. If you didn't have that context, you sit on your hands. Now, you could enter when you see these high offers, but what you'll find is if you just enter because of big offers, bids and offers, it's going to be very hit and miss, even if you are in a potentially new downtrend. And it's extremely rare for me to make a decision to enter a trade because of high bids or offers. It's useful information, it's just not enough on its own. So selling in front of large offers or buying in front of large bids is going to be a net losing strategy. Now, where I am more likely to enter is where the stuck buyers look to be getting stopped out. So we can see that the buyer absorption started really around 30.53 up to 30.57. And that means we have a cluster of short-term long positions there. Now, not every trade on the way up is going to be people entering long directional positions, but on balance, there will be more new long positions here because we traded more volume here. And when we break this area to the downside, some of these trades will unwind and help us on the move down. And that is the point at which I'm personally looking for refinement over here on the depth and sales. So I'm watching the market tick up and down. I'm looking for the ticks up to be weak and short-lived. I'm looking for the market to start driving down into those stops, looking for signs of downside momentum to build. Now we can see that to an extent over here where we've got the majority red on the trade thermometer, but it is actually much easier to read watching the ticks up and ticks down on the depths and sales. So a lot of people say to me, well, Pete, what's a signal to sell on Auction Vista? Now, it's a fair question. It's nuanced. It depends on your risk tolerance. But there are 4 distinct phases. The first one is you see the depth above you. That could be resistance. It could equally be fake. What it does mean is absolutely an area of interest. We then trade into that depth and the depth remains. It doesn't pull out of the way. The depth is real. The amount we trade in there then becomes exceptional size. So it means in this case that some new buyers are getting stuck. We've got exceptional buying, but the sellers are still taking on those orders. So like I said, these trades don't all have to be buyers initiating new trades. Some could be exit orders, some could be spread trades, but on balance, there's going to be a good enough proportion of new positions here to help us when they stop out. So seeing the size trade is another heads up. And then number 4, the market starts pushing down. That's your last signal, effectively, pushing those new speculative buyers out. And at that point, the probability of a profitable short increases, but you have lost a few ticks on the entry price in getting that confirmation. So at any point from seeing the large offers above to the buyers getting stopped out, you could have gone short, and where you go short depends on your own tolerance for risk. Now, one way to think about this, if a seller has a big position to fill. There are firms out there whose sole job is to fill big positions. And they feel that the buyers are drying up here. So they've absorbed all this buying up here. They feel there's no buyers up here. At some point, they're going to switch from passive selling to active selling and start throwing market orders in, which is why I wait for the turn. Because they could be quite happy to absorb buying at higher and higher prices. But when they think the buying is drying up and start to push the market down, that's when I like to get in. Now this slide is typical of cases where a turn in the market is defined purely by order execution and the depth isn't adding really any significant information. So we've got iceberg orders being executed, we've got something I call hidden backstops being created, and we have opposing imbalances at extremes. Now as we can see, the market moves up to 1912, can't push through it. Yet the depth as we got up there was quite normal. Now the volume at 1912 is exceptionally high and the aggressors are almost entirely buying. Price can't move through 1912, but we see no sign of large size on the offer side. And that's only possible if there's one or more iceberg orders on the offer side. So as buyers buy, more contracts are added to the offers and the buyers get trapped. And what happens in the end, we end up trading 3,870 contracts into that price, 1912. So if there's no depth, but a large trade circle, that's an iceberg. Now this sort of activity, stopping at a single price with large trading at that single price, is typical of thicker markets like the E-mini S&P 500. And it's quite rare to see this sort of thing on thinner markets like crude or DAX, where the market tends to trade high volume over a series of prices, as we'll see in a minute. Now, we also mentioned something called an opposing imbalance. Well, we're imbalanced to the buy side at the high. Okay, so that's the opposing imbalance. So buyers are active in terms of market orders, but sellers aren't. The smart sellers are adding to their offers. Now, at reversal areas, it really helps to see the market imbalance to the buy side at a high or the sell side at a low, hence the term opposing imbalance. So it's not just the circle size that's important. I mean, if you just saw the big, a lot of size trade there, there's still a queue, but if there's an imbalance there, that really helps. Now, areas like this are things that I like to call hidden backstops. They're areas which might look completely irrelevant from a charting perspective, but they have order flow supporting the level holding. So in other words, the order flow is giving us trade entry points that might not be visible to a chart trader. And this is one of the most powerful aspects of the order flow history, giving us lines in the sand that can be both entry points and signals to exit if price crosses that line. So for instance, if you were short here at 1912 and price got to 1913 or 1912.50, 1912.75, you know your trade's in peril. You've got enough sellers absorbing contracts up there that they're going to get stopped out if it moves up through there. So it gives you a very, very good, nice tight stop and good potential to the downside. Now, of course, you don't have to enter when you see the circle. In fact, it's often better to get in when you see the market start to break down. So don't think of this as a chart with a single entry point. You can get in when you see the traders trapped, or you can get in when you see the market start to move against them. And sometimes there's as much information in what you can see as what you can't. So for example, we can't see excessive offers at the high, but we knew they were there and trying to hide because we saw excessive buying. So always think about what you see as well as what you don't. Now, I like to separate turns in the market into major and minor reversals. So a major reversal would be one that initiates a new intraday trend, you know, the 3 or 4 major swings we seem to get in a day, on a kind of speculative day. And a minor reversal would be a simple pullback. Now, the end of trend moves are very busy. There's a lot more trading involved in reversing an intraday trend than reversing a pullback. There's more people engaged there, and it's also a spot where you find more predatory traders. Now, in this image, I've got the depth tuner set to only show the most significant depth. So that's why a lot of the depth appears to be missing here, because I've basically tuned it out. Now, we start this image on the left with consolidation, and this was consolidation after a move up. And basically we move up through the consolidation area and then back down to it. And this is our pullback, and it is a very typical pullback. And we can say a few things about the end of a pullback. It often tests the high of the prior consolidation area or high volume area. Sometimes an iceberg order will stop it as bidders step in and absorb the light selling, but a lot of the time you simply run out of momentum and sellers stop engaging. And this sort of turn is defined mostly by a lack of activity. So we don't see much. And this lack of activity is as easy to read on the depth and sales over here as it is on the chart. Sometimes you just go back to a price a couple of times, nothing really trades, okay? Now, as you move to the top, the full reversal, we can see a lot more activity. So we can see an area, absolutely, this white area here, of high liquidity above us as price moves up. We can see it's taking progressively more and more contracts to move up through prices. And this is very typical of a thinner market like crude or DAX, to see the market thicken up over a series of prices prior to reversal. And once again, we end up with a very large circle where aggressors are mostly buying, and after just another tick up, the market falls away. Now, in terms of an entry, entering on that high volume circle with the backup of the depth above is absolutely a place you could enter the market, but in my opinion, it's still a risky trade. So my preference is to actually let the market break down, see some downside momentum, or even wait for a weak pullback. And again, the cost of the confirmation is you give up a few ticks on the entry price, and it just all comes down to your own appetite for risk. Now, many times the market depth is really, really irrelevant. It's not a big part of the story. And in this image, we can see just one price with significant depth, or it's definitely not the highest amount of depth. And we actually traded through that before an iceberg order held a few ticks down. And once again, we've got the opposing imbalance, aggressive sellers at a low, and we know it's an iceberg because the depth there was insignificant, yet a large amount of size traded. And for this to happen, bidders must have added contracts as we traded there. But for the rest of the time on this chart, the depth is completely insignificant. Now we can see a hidden backstop created by the trap sellers over here, and the lack of selling interest when we came back to that low. And that lack of interest, again, would easily be visible on the depth and sales as the history chart. And many times you're going to see the market eat through areas of high liquidity, and sometimes that liquidity is just one half an arbitrage strategy, so it's got no real bearing on direction. So this liquidity here could have been half of a calendar spread, okay? And over time you'll learn that liquidity alone won't stop the market, certainly not reliably enough for a full reversal. So seeing the liquidity gives you a heads up that something may occur. It's a good heads up, but it's just that how the market reacts, where size trades, is more important than the market depth. Now, not every trade will follow through. So let's look at how we can handle scenarios where we may have gotten into a trade that then moves against us. What is it we can see that gives us a heads up? So in this case, we can see the market is coming down towards an area of high buy-side liquidity here. 30.35 is a point of control, and we can see large bids below that, which is actually quite normal. Now the market is in an overall down move, so any long trade is going to be against the overall trend. Now as price drops, we do see that depth is added to the bids, and we get to 30.35, we see exceptional selling there. We do see some of the bidders pull their orders here, but bear in mind there's a lot of participants, and there can always be a mix of spoof and real orders at any level, so don't think these high bids as all belonging to the same participant. We get this first large red circle that eats most of the liquidity at 30.35, but each time we come back to 30.35, we see exceptional size trade. Again, obviously an iceberg order there, and we can see the aggressors almost entirely selling, but price not moving down, sellers are getting stuck. We end up taking 6 attempts at selling through 30.35, and then we move up, but just 5 or 6 ticks. Now the buy side liquidity does follow that move up, but as we move back down, we can see the large bids at 30.36 get eaten, and in what a fairly rapid move down, we eat through all those bids, market collapses. Okay. Now as an order flow trader, you know that at this area over here, buyers absorb the selling. Okay. And those buyers are in peril if we move back down to this area. So if you'd played the reversal here and taken a long, then seeing the momentum back to your entry price should have been your cue to get out. And we can see over here, we look at the size of the trades as we get down to 36 and 37. This is crude. 68 contract trade, 160 contract trade, 36, 37. We've got some size coming in. Now this area here, if you hadn't taken the long trade, this area here is also a potential entry point, because there's plenty of short-term traders that trade momentum into stops. They are very fast trades, you're right or wrong very quickly, but that is a very common trade. Now the trade that most traders aren't looking for is up here, the weak pullback into the area where high volume trade is. So we can see a high volume traded very quickly, all those bids got taken out, and then you've got a pullback into that high volume area. So buyers are holding off. We're going to see as we get up there, buyers are holding off. There's no real size. Look at, we just got one price where we've got 38 contracts. There's no real size on the way back. And again, looking for an entry here, that's one of the trades I like to take. Basically, look at where the volume traded, weak pull back into it, then take a trade. One of the easiest trades to take. So once again, we have a potential entry point here, but it's more because of lack of activity than large size trading. So my experience is the easiest trades to manage are those where you pull back to an area of higher volume, and at the same time you see an extremely weak counter trend momentum. Now don't worry about learning all these things at once. As you get more experience, these things are going to come to you, but just bear in mind that lack of activity is often going to have as much meaning as lots of activity. Now, this is a bit of a busy slide, but we mentioned earlier that context matters. So let's take a step back and look at how this fits into the big picture, okay? And how we can use this information along other actionable market information, how we can use this to confirm trades and give us additional entry points that might not be on a chart. So in this market, what we've done, we're looking at a full reversal on the ES. Okay, so the market's put up a 15-point move with actually decent volume. We can see volume recovered here. Now on the way up, we actually paused at 125, 2001.25 to 2250. We actually built a bit of volume there, and it's normal to see pausing trends like this. We've done webinars here before, day trading without charts. You know, market likes to move up, build volume, move up, build volume, and these volume areas should hold on a retest or the trend is in peril. Now we see some large size traded here, but we never moved against that size. So in effect, what we've done, we've traded around volume, not back through it. And from a value trader's perspective, value traders say, well, we're finding value here temporarily. On the next push up, we can see absorption at the high. So that's the opposing imbalance. Now that area is quickly broken to the downside, and that would be your highest risk, earliest entry opportunity. Now, why would you enter there? Well, first of all, the absorption at the high, okay, if we just go across here, it's the day session weekly high, okay, and it's also just before these X's, which is marking out an area of high volume from overnight. So we actually have good trade context here. So it is a potential area to short, either on the circle itself, which is high risk but good price, or just below as it breaks down, which is lower risk but poorer price. Now, as we get back down to this area of high volume, we can see a bit of large size, imbalance on the sell side, which means the bidders are absorbing contracts. And you should expect additional volume to trade. If you've used volume profile at all, you know that as you get back to an area of high volume, you tend to trade high volume again. Okay, so as we got back to there, we got a little bit of higher volume, and looking for this area to break would have been your next opportunity to enter. Now we do break down to an area of high volume, and we can see the Dow, the Nasdaq moving off their highs, the NYSE tick starting to show signs of a stock market sell-off. And next we get this weak pullback. So where are we pulling back to? We're pulling back to this area where we traded the size before. And that gives us the last selling opportunity that's visible on this screen, although more pullbacks would occur later. And what can we see here? Well, we can see weakness in the pullback. Okay, we can see there's no move up in that pullback. The delta's not moving up in that pullback. The Dow and the Nasdaq and the Dow aren't moving up in that pullback. So as we pull back up here, there's no sign of strength. Okay, on the tick, the Dow, the Nasdaq, or even the S&P 500. So we've got context, we've got other markets confirming, and we've got order flow all coming together to help us gauge the pressure to the downside.